The Federal Reserve's recent decision to cut interest rates has sparked a wave of curiosity and debate, especially when it comes to its impact on mortgages in Florida. This move, the first rate cut since December, has sent ripples through the market, with many wondering what it means for the housing market and homeowners. The Fed's independence, a topic of growing scrutiny, faced a crucial test as it balanced its mandate to tame inflation with concerns about economic resilience. Weaker employment data tipped the scales, leading to expectations of further rate cuts before the year ends. But here's where it's controversial. While inflation remains a concern, the true impact of tariffs on prices is yet to be fully realized. This adds a layer of complexity, as tariffs are outside the Fed's traditional control, creating an upward pressure on prices that the central bank can't easily address. Most consumers might not realize the far-reaching effects of the federal funds rate. It's not just about banks lending to each other. It influences credit cards, auto loans, and, crucially, mortgages. However, mortgage rates are more closely tied to the 10-year U.S. Treasury yield, which can move independently of the Fed's actions. In anticipation of the Fed's move, mortgage rates dropped to their lowest levels since October, with a significant surge in applications and refinancing demand. Adjustable-rate mortgages (ARMs) have been popular, offering initial rates lower than fixed-rate mortgages, providing borrowers with some protection against short-term volatility. And this is the part most people miss. History shows a clear link between mortgage rates and home sales. Economists estimate a 6% increase in home sales for every 1-point reduction in mortgage rates, with some projecting an even higher impact. If rates continue to fall, we could see a significant release of pent-up demand, especially in regions like Florida's Gulf Coast, where housing supply has normalized. However, many regions across the country still face constraints, and for a national sales acceleration, homeowners need to see mortgage rates as low enough to justify moving on. A recent study found that a 1-point increase in market rates above a homeowner's existing loan reduces the probability of selling by 18%, leading to a significant drop in mobility rates. In Florida's luxury market, cash purchases are common, especially in the $1 million plus range, which might suggest a muted impact of lower rates. But history tells us that borrowing rates move in tandem, lowering the overall cost of capital and increasing optimism for significant investments, including housing. So what rate would be the tipping point to reverse this trend? While no one can predict with certainty, many believe a rate with a 5 in front of the percentage sign would be a powerful catalyst for buyers and sellers. The bottom line, the Federal Reserve's rate cuts have the potential to reinvigorate the housing market, but the true impact will depend on various factors, including the trend of rates over time and the overall economic landscape. What are your thoughts on the matter? Do you think lower rates will be the key to unlocking the real estate market's potential? Feel free to share your insights and opinions in the comments below.